Hello and a warm welcome to another edition of Econoday Unplugged. It's Thursday, the 3rd of November 2023. Mark Penders on the US East Coast, and I'm Jeremy Hawkins in London. Over the last week or so, we've seen the European Central Bank, the Federal Reserve, and the Bank of England all raise interest rates by a chunky 75 basis points. Add to that trio, we can also put in the Bank of Canada and the Reserve Bank of Australia. But in contrast to the former group, both of these central banks again opted for a smaller increase in rates than they delivered just a few months ago. So, with global recession worries to the fore and investors on the lookout for any sign of a so-called pivot in monetary policies, could it be that the next round of central bank tightening in general will also be less aggressive? If so, the peak to official rates might not be too far away. So, as usual, let's go stateside first. Mark, amongst the mentioned collection of central banks, the Fed yesterday announced another hardly unexpected 75 basis point increase. That again matched the largest move we've seen over the current policy cycle. But was there anything in the commentary to suggest that another probable tightening in December will be any more market friendly?
Well, there was the inclusion of the cumulative effect of prior interest rate increases, which hints that they may be slowing down, that it's time now maybe to take a look to see what we've done if you're the Federal Reserve, and see if indeed the prior rate increases, which what have they totaled now? I mean, they've totaled
300 basis points. I've got my numbers
from,
wrong.
let me just see here. Yeah, from the midpoint was 1/8 at the beginning of the year, and now it's 3 7/8. So that's 375 basis points of cumulative increases, and the 3 7/8 is not quite or roughly double what the Federal Reserve sees as the neutral rate. And Jerome Powell actually cited the 2% number in yesterday's press conference as roughly what the neutral rate would be. So that indicates then that policy has moved from accommodative, the post-pandemic or effort to stimulate the economy, into a restrictive zone now, and how restrictive it is still up in the air.
Okay, if I ask you, if you're talking
yeah.
about perhaps smaller interest rate hikes than we've seen in the last several rounds anyway, but do you think there's a possibility we might actually see a pause in the rate rises, or is it just a case of increasing them by a smaller amount?
That's so funny because we can't. And that's one possibility. Another possibility is that we may have to go up to 100 basis points from 75. Now, reason I say that is all this is going to turn on inflation expectations again and again and again. It's inflation, actual inflation readings as a leading indicator of inflation expectations for businesses and consumers, and that's when psychologically we begin to change our spending and investment behavior based on expectations that inflation is going to rise. So that would mean buy now. For instance, if you're going to get a refrigerator before the price goes up too much, and they're trying to slow demand. So, I mean, that is in theory what the risk is, the psychological human factor. And the inflation numbers actually aren't really subsiding very much, if at all. I mean, we can just look at the inflation expectations numbers on the consumer side in October actually went up 0.3 to 5% on the University of Michigan's measure, which is a very closely watched measure here. And that's down from a peak early in the year at 5.4%, but it's not going in the right direction. And the same thing, and this is what Jerome Powell also pointed to, was the PCE core price index, which is arguably the biggest, most important inflation indicator for Fed policy. And that moved up 0.2 to 5.1% and is up 0.4 over the last two reports as well. So that's also going in the wrong direction. If inflation continues to go in the wrong, if these core readings continue to go, and these are excluding energy. Now, energy is having less of a factor now because it's edged back, but we have OPEC if they're going to cut production. Now, all of a sudden, if oil comes in, or we have some kind of a shock related to the Ukraine war, or related to OPEC desires, then if inflation comes back, the cumulative effect line will soon be forgotten completely. So I agree that we're more likely to slow, but there's also the possibility that another 75 may not be out of the question. I think it'll
Okay.
all
Let me
go
ask
down
you
to the
also, one of the
CPI.
interesting comments I thought Powell made yesterday was, to quote him, incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. So do you think we might be in a world whereby we might get smaller rate hikes, but we're still going to get more of them because the absolute level of interest rates where they're going to peak out could well be that much higher than if they'd thought previously?
Yeah, so that's another possibility, is a slow bleed of continuing rate hikes. But have they got out? That really would depend. Is have they got out in front of the curve? So they risk the worst possible policy disaster for central bankers, is that they're behind the inflation curve, because what are they getting paid to do, right? And so they have to choose now. So I mean, they have to choose. They may drive us into recession, but one thing they can probably do is kill off inflation, you would think, even though there's cross currents here, because it's not just demand related inflation, it's the lack of supply. Because of the supply constraints. Now we also have Chinese COVID, right? Zero COVID is back in the game. We saw the Chinese PMIs begin sink just this week again. So if you're going to have, you're raising rates, but to kill, and you're going to agree to a recession, or you're going to concede the recession in an effort to, and you're confident that you can kill inflation. But maybe this is an odd time. Maybe you can't kill inflation. Maybe the supply constraints are going to, whether it's OPEC or cutting production, or it's zero COVID, and all the commodities that the Chinese produce, that could be a risk for inflation. So I don't think we're completely out of the woods. As far as the pace of monetary policy, I think it's like I said, unfolding. It's going to unfold based on the inflation readings that you see.
Okay, well, talking about inflation, we may not actually have an inflation number per se tomorrow, but clearly we will be getting an update on the employment situation, so at least some idea about what's happening to the supply side of the economy. So what's the expectations regarding that?
Average hourly earnings, the Econoday consensus is no change on the monthly rate at 0.3%, which is a moderate rate, and a 0.3 decline in the annual rate to 4.7%. So that would be going in the right direction.
And what about payrolls?
Payrolls are slowing. The Econoday consensus is a 210,000 rise. This would be compared to 263,000 in September, and actually that would be the lowest. The 210,000, I checked that. That would be one of the lowest of the post-pandemic era or recovery. So, but we had jobless claims this morning, and they were steady and low, historically very, very low. We are getting anecdotal reports in the business surveys that unfilled vacancies aren't being filled. The employers, because they're concerned of slowing demand, are just keeping when positions are empty, they're not filling them. But in any case, and this is another factor, Jeremy, that will give the Fed leeway to not slow or to limit how much they may slow down their rate cuts, because if you have this underlying strength in the labor market, that allows them then to focus more or shift their ammunition to hit inflation. So the fundamentals for the U.S. economy, if it wasn't for inflation, are pretty strong. Although we have weak foreign demand. We had a big $73.3 billion deficit in goods and trades and services this morning, and it was related a lot to troubles in foreign demand, and that is an increasing comment you see in the business surveys. But the U.S. economy is comparatively insular, so we can rely on internal demand quite a lot, and the U.S. is still big consumer of imports, consumer goods imports, capital goods imports too took off. So these are all negatives. Capital goods exports were really very strong this last month, and that's a negative for the trade balance, but that's a positive for business investment and for future productivity.
Okay, excellent. Thanks for all that little lot. Right, well, let's keep moving on then. So we'll go across to Europe and my side of the world, at least as far as the European Central Bank is concerned anyway. So last week then, out of the ECB, we saw rates also up 75 basis points. Also, our Fed in line with expectations. So refi rates over there now stands at 2%, deposit rate at 1.5%, and the marginal lending rate at 2.25%. Now, the bank noted that it made substantial progress in terms of withdrawing monetary policy accommodation. I guess that's kind of, harks to what Mark was just talking about, looking at the cumulative amount of tightening that's been undertaken so far. But it also said it still expects to raise rates further. So certainly no indications at all that interest rates may have peaked as far as the ECB is concerned. And indeed, they still pointed out that there's upside risk to inflation, which is obviously their key target, as with so many central banks at the moment. So no hope of any pivot there, at least not for a while. And the bottom line is inflation is simply too high. The flash October data remarkably surged from already strong 9.9% up to 10.7%. That was miles above expectations, and effectively easily more than offsets the impact on real interest rates of the latest increase in official nominal interest rates. So bottom line, I guess, suggests that policy is still too accommodative there. So I guess if we are going to see any kind of change in interest rates in December, which we almost certainly will do, most likely at this stage is we'll see another 75 basis points, and anything less than that at this stage, I guess, is still fairly unlikely. Indeed, as Mark alluded to, inflation expectations are so important to many central banks. They're certainly particularly key to the ECB's policy-making arm. And there they had their own survey of forecasts released at the back end of last month, and that showed the 2023 inflation forecast rising from 5.5%, at least 5.5% in the ECB's own projections, up to 5.8%. So essentially, all the inflation numbers, as far as the Eurozone is concerned at the moment, are still very much moving in the wrong direction.
Can I jump in?
Yeah, sure.
One, and you covered it this morning. One, that it's not a Eurozone member, and I don't know why we should just all go move there. I'm sure they would love to have all the migrants. Is Switzerland? Their inflation rate is moderating, and it's came in at an annual 3%. Imagine 3%. What is it about the Swiss, and what does that mean for the Swiss National Bank?
Good question. I think as far as the low rates concerned, as you mentioned, it's easily the lowest rate looking across Europe at the moment. I think it's a reflection of a number of things. One, the fact that inflation in Switzerland has always been so low for so long, and that's the key reason why it's been the investors' currency of choice, if you like, particularly during times of uncertainty from within the European currency bloc. Also, that's the fact that, partly due to that, because it's safe haven status of the currency, we've had huge capital inflows going into the Swiss franc, which means that losses against the likes of the dollar have been much smaller when we've seen for the likes of the pound, or particularly the likes of the euro as well. So a lot of imported inflation that we've seen coming into a lot of continental Europe, it simply isn't happening as far as Switzerland's concerned. So imported price inflation in Switzerland at the moment, remember off the top of my head, is around about 7% or so. Domestically generated inflation is struggling to get much above 1%. So by and large, I think it's a case of the fact that inflation has been so well managed for so long, and also key factors like the exchange rate have gone in Switzerland's favour, that they'll be able to keep the inflation rate down as low as they have. But to answer your question, I'm going back to where I first started answering it, really. The SNB are determined to keep inflation low. They don't have a pure 2% target. Their definition of price stability is a rate just below 2%. It's a bit like the ECB used to have. And as soon as they see inflation going above it, And although it's come down to 3%, that's still a full percentage point above 2%. Their attitude is we're not having that, and therefore we'll tighten until such time as we think we've got rates at the sort of level needed to meet the target. So although inflation internationally in Switzerland is just very low, you can bet that we'll see interest rates in the SNB going up again at the next policy meeting next month.
Huh.
Okay, let's move quickly across to the Bank of England then, who, just a few hours ago now announced also a 75 basis point increase, which put their benchmark rate, the bank rate, up at 3%. Now, it's the largest increase in interest rates we've seen over here since Black Wednesday, when the bank was struggling to try and support the pound, and interest rates went through the roof in different stages during the course of trading.
And
but
that was
no
what,
real sign
19
of any kind of near-term pivot.
That was 30 years ago?
Here either.
That was 30 years ago? Black Wednesday? Was it?
Sorry?
30 years ago, Black Wednesday?
Yeah, 1992.
1992.
When they were trying to keep the pound in what used to be the exchange rate mechanism of the European monetary system, and it was duly ejected when at the end of the day,
that was an emergency thing, but this one wasn't. It's not considered an emergency, right?
No, this is a proper meeting. So, and the last time we saw rates going up this high was about 40 years ago at an actual scheduled meeting, certainly. But in terms of actual individual, moves per se, it was Black Wednesday, and we last saw them go that far. But what can I say anyway? So it's got to be said that I think the Bank of England's in a bit of a strange place at the moment. So we come out today and hiked interest rates by 75 basis points. However, if you look at their forecasts, and they produce two sets of forecasts, one keeping interest rates at the current level and one looking at what the markets were saying. Well, their base forecast normally factors in what futures prices are saying about bank rate in the UK over the next 3 years or so. On the basis of that, their inflation forecast shows CPI inflation below target in 2 years' time, which is kind of the policy horizon, and even further below 2% in 3 years' time. And even if interest rates were left at 3%, they got inflation round about 2% on target in 2 years, and again below 2% in 3 years' time. So, taken literally, if you look at what their economic forecasts are saying, they're really intimating there's no need to really come out and raise interest rates aggressively anymore. However, from everything the governor's saying in his press conference today, it seems fairly certain that interest rates will be going up again, simply because inflation at the moment in the UK, around 10%, is too high. But I think you're trying to reconcile what the economic forecasts are saying with what the bank is actually doing with interest rates at the moment. It really makes for a pretty messy picture. And I guess the bottom line, well, two things I think we can say coming out of this. One is that the bank does not believe in market pricing for interest rates. They're thinking the financial markets are pricing in too steep increases for bank rate. And two, they're really struggling to work out what the heck's going on with the UK economy at the moment. I mean, taking their forecasts at face value, what they come out and suggested today is that the UK has started what will be the longest recession on record. So they believe that the UK's economy is already in recession, and they expect GDP to continue to contract throughout 2023, and indeed now they've extended that into the first half of 2024.
Yikes!
We saw
when you look at, you're not supposed to raise rates in a recession. If you look at the Fed graph, for instance, you'll see that we had two recessions. We had a tiny little recession that no one knows about right when. For 2 months, right when COVID hit, and rates were coming down. And then we had the 2007, 2008, and rates were coming down. Now we're having a recession and rates are going through the roof. So that can't be good.
No, it can't be good. I mean, the governor's point of view is that, look, if we don't do what we're doing now, then rates will have to go up even higher in the future, which would make the downturn in the real economy that much steeper. But I must say, you look at the bigger picture, and you've got to start wondering whether or not pushing interest rates up at this time is as quickly and aggressively as that is going to be the right thing.
So the BOE's next meeting is next month, right?
The last meeting of year will be in December.
What do you think markets are going to be thinking?
My sense is the bank would like to raise rates no more than 50. But if we get another bad inflation number next month, then they'll probably be forced to do another 75. And as we speak, financial markets now are currently pricing in a peak to rates around about the middle of next year of 4.75%. So if that's the case, that's still 175 basis points, if it's correct, 175 basis points above where we are now to be delivered in a space of, what, about 7 months or so. So it would suggest there's still a fair amount of tightening to come through. But so much of it is going to, as you were saying, is going to come down to what happens on the inflation side. And if it turns out that the UK economy really does implode, it drags inflation down, then who knows, the next move in rates could even be down rather than up. But at least at this stage, that doesn't look likely to be the case. I should also quickly mention, with regards to the Bank of England, of course, they this week became the first of the major central banks to start an active quantitative tightening program, whereby they're actually involved in outright sales of gilts. So it's not just a case of running down the balance sheet by allowing maturing stock to run off. They're actually coming out and selling gilts now into the market. They had their first auction on Tuesday, and the good news for them, because clearly there were concerns that once you start getting this active QT coming through, it could really push up bond yields even further. The auction went extremely well, had a very high cover ratio, and that at least will give them some hope that they can continue with the other 7 auctions which are scheduled for this quarter through year end. They can get away with those without upsetting the bond market too much. Right, let's quickly round up with a couple of the other central banks then. Bank of Canada. I guess if you're looking for a central bank where the so-called pivot may not be too far away, then Canada is at least one of the options. So they've lifted rates by fully 100 basis points in July. In September, they did 75 basis points. And to general surprise, back end of last month, they only did 50 basis points. And looking behind that, it does seem now as if they're becoming a little bit more cautious about what's going to happen to the economy. The governors admitted that there is at least a chance of recession, or certainly a period of stagnation next year. And when we look at the numbers, over the last 3 months, GDP's expanded just 0.1%. Employment's fallen, over 90,000 since May. Tomorrow's employment report is expected to show a relatively weak picture as well. Now, all that said, they may not be raising interest rates as quickly as they have been, but don't look for any early easing. Headline inflation has actually come down quite significantly in Canada. It was 8.1% in June, the peak, and it was down to 6.9% in September. But the average of the Bank of Canada's preferred measures, their core measures, only dipped a couple of ticks over the same period, so still very high at 5.3%. And also, the Bank of Canada still sees a good deal of excess demand. I'm going to want to see that output back gap reverse, I suspect, before they really feel comfortable about taking interest rates down. Indeed, just interestingly enough, just yesterday, the Bank of Canada Governor Macklem suggested an outsized rate hike is still a possibility if needed. I think in many ways that kind of sums up just what's going on for all the central banks at the moment. They're just so uncertain about how these economies are going to perform.
But based on the Econoday Consensus Divergence Index, which tracks how well a country's actual data are performing relative to economists' expectations, Canada has been out in front consistently for over the past year, and they're at a score of 42 right now after today's merchandise trade data, and when excluding inflation effects, they're at 33. So these are it shows that economists are appreciably underestimating the strength of the economy. And doesn't that give the Bank of Canada then some leeway to go ahead and, like you were saying, if they need to make a big rate hike, they could?
Yeah, I think that's exactly right, and it's a good point. The fact that if we stretch it back, beginning of this year, really, Canada has been, of the G7 economies, probably the one that's most consistently outperformed market expectations. I suppose when we look at the amount of tightening the BOC's done so far, it amounts to about 350 basis points, I guess. So it's only a little bit behind what the Fed's done, and that is testament to the fact that the economy has been doing so well. But yes, you've got to say, for an economy like Canada, where by and large it's still performing pretty well, it must be so much easier for them to come out and hike interest rates than for the likes of the Bank of England, which has already admitted we're in the start of what is supposed to be the longest ever recession. Right, okay. I need to mention the RBA as well, because in the intro we talked about a couple of central banks which appear to at least got past the peak of the size of rate increases. So the start of this week, the RBA hiked by 25 basis points. That was as expected. And that also matched the increase they saw previously, but down from the 50 basis points that they were implementing before that. I guess that also suggests that there's more focus on the real economy now, or at least some kind of sense that the economic slowdown will help to cool underlying trends and remove some of the upside pressure on rates. But even so, I mean, again, I think the RBA stressing there's also a lot of uncertainty about the way the economy is going to go. And indeed, the governor again came out and said he wouldn't rule out a 50 basis point hike in the future, or indeed even pausing the tightening process. So I suppose for all the central banks currently, it's very much the case that taking each meeting on a meeting by meeting basis according to the data, and that really does suggest that the kind of idea of forward guidance that we became so used to during the peak periods of COVID, that has very much gone out of the window now.
Yes, and thanks for that, because that was my impression in the Fed's that people's reaction to the Fed yesterday. I mean, Powell had to downplay it, but there was a lot of energy in that citing of the cumulative effect. But in a way, that doesn't mean, that's not a guarantee that we are actually pivoting lower for the U.S.
Right. Fair enough. And let me round up finally at last. I've got to mention the Bank of Japan, because there's always an exception to the rule. And of course, the BOJ is very much one at the moment. They left their policy setting unchanged last week. However, I think what you can say about them is taking on the market is becoming at least increasingly difficult. And the bank announced that it would be increasing the frequency of its bond buying this quarter, which effectively implies it will be buying more bonds as it tries to keep the yield curve under control. But of course, by keeping yields down, it's just adding to pressure on the yen. And we now know that the BOJ spent a record 6.3 trillion yen, so over $42 billion in October, trying to counter the yen slide. So there's a lot of speculative pressure on the currency at the moment, really being initiated by the low level of interest rates and the refusal of the authorities to push interest rates higher. So although there's no near-term change for Bank of Japan policy, the general expectation, it could yet be the case that markets force them to a shift in the same way that go back a few months or so ago, of course, they forecast the RBA to come out and abandon their yield curve control as well. Okay, anything else from you, Mark, before we wrap this little thing up?
No, thank you so much, Jeremy, for all that. I appreciate that. That was really it's amazing what global monetary policy is fumbling around with right now.
It is. I mean, I think with the fiscal policy and everything else, it's going to be, it's a very messy time if you're a central banker or policymaker in general. Okay, then that's probably it as far as today goes. I guess any talk of a pivot on official interest rates looks premature, but clearly for at least some central banks, well, they do believe that outsized rate hikes may, sooner rather than later, no longer be needed to bring inflation under control. Either way, it's all down to the data, and the best way to keep up to date with them, and indeed all the other key market moving events, is via Econoday's global economic calendar, so do take a look. So on behalf of Mark and me, thanks as always for listening. We hope to see you again next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your Econoday Investors Journal now at shop.econoday.com.